Adam, tell me something exciting about the ECB. Am I looking for clues? Am I looking for clues about September?
God, mission impossible already. But in terms of, obviously the setup for this meeting, clearly it's changed relative to where we were a few weeks ago, given developments in the energy markets. But ultimately, nothing's really priced for today. And I think a big part of that is we're not really seeing too much of emergence of second-round inflation effects. And also, survey data by Bloomberg says that 91% of those surveyed don't see any signs of inflation expectations being de-anchored. We're seeing that play out in market gauges, short-term inflation gauges, longer-term inflation gauges, so things are relatively steady. And we know the ECB prefers to kind of wait for these September forecast meetings. I think what's interesting for price action bonds at the moment is just how little we moved yesterday. So energy was skyrocketing and bonds weren't really doing a great deal, which suggests the market is kind of comfortable with where they see terminal at the moment. If there is a tail risk, not my base case, is that they do move today. I mean, ultimately, their forecast embeds multiple hikes. Growth holding up relatively well, shown by PMIs. Corporate earnings doing relatively well. But even then, that may just be seen in the case of bringing forward expected tightening rather than a deeper tightening cycle.
Is Google spending too much money?
I mean, that's the verdict of the market. I mean, we saw the cloud revenue results are relatively good, but, obviously, the CAPEX is what everyone's talking about today, the free cash flow guidance. Obviously, cash rate hasn't even opened today. That will deliver the actual verdicts on it, but the signals are they've perhaps overcooked it a bit. We saw some signs of AI monetization, but ultimately, the CAPEX just brings greater scrutiny under that. And then, obviously for hyperscalers, we get a really busy docket next week, and I think that's really just kind of raised the bar for things, and results are going to get scrutinised even more. In terms of what the tech trade's looking like today, it looks like it's unambiguously positive for chip names. We saw that on display overnight in Asia, outperformance. Let's see what Intel brings today. But at the moment, it just feels like there's a lot of noise going around the tech trade. If you want something a bit steadier, you prefer value over growth, then, Europe looks like a better bet.
OK, and what about the Japanese story? Because a little bit later than this time yesterday, we got news that the Bank of Japan was prepared to move faster than expected, faster than the sort of 6-monthly cadence that we've grown to understand from them in terms of rate hikes. And that seemed like a big deal for markets. Is that a big deal into the long term, or is it just a big deal in that very moment?
It's a big deal if it happens. If it happens, that's the thing. It seems like the same old when we talk about the yen. Negative terms of trade shock from the Iran war. We saw disappointing trade data early in the week. Yes, OK, they may go quicker than 6 months, but the reporting is relatively vague in terms of timeline. If they're serious, they'd hike next week, but it doesn't look like they're going to. At the same time, for dollar yen, you've got Fed pricing ratcheting higher. I think for dollar yen to turn around, it needs more serious BOJ hikes, Fed hiking expectations to ease off a little bit, the war to end. If that doesn't happen, then I think we see a bit of a steady grind higher towards 165.
Adam, thank you very much.